Anglo American Platinum says it plans to cut thousands of jobs at its mines in South Africa after profit plunged by 71% last year. The company said in a statement that it is embarking on restructuring that could affect about 3,700 jobs at its South African operations, or 17% of its workforce, as it battles to keep a lid on costs after a slide in the price of platinum group metals. For more on this and the company results, we are joined by Seleho Tsatsi, who's an investment analyst at Anchor Capital. Seleho, thank you so much for your time. Judging by the share price reaction, up 1.3%, I suppose from a numbers perspective, a lot wasn't unexpected here. But were there any surprises for you when you look at this company's earnings and the restructuring plans?
Hi, Anastasia. Great to be with you. I don't believe there were any real surprises, given the fact that Anglo American Platinum did provide us with a trading update earlier this year. So we were quite aware of what the trading range was, or the earnings range was going to be coming into the set of results. What I found most surprising, though, was their commentary on the metals, so the PGM metals, particularly palladium and rhodium. They've said that they expect palladium and rhodium to be in a surplus in 2025, which is really fascinating when you consider how much of a decline these metals have already experienced. So that was something that caught our eye, definitely.
What are some of the dynamics that are playing out in the PGM space when it comes to, I suppose, supply and demand?
Yes, so in reference to that, to what they talked about in 2025, one of the things that they are expecting is for the shift that we are already seeing towards battery electric vehicles, or BEVs. They expect that to impact, for example, palladium demand in 2025. The automotive sector, or the car sector, is a really significant source of demand for platinum, palladium, and rhodium. And so the fact that we are seeing the world shifting towards a more electric car base is impacting demand. We don't think it's going to be, we aren't going to get to 100% electric vehicle penetration soon, but on the edges, it is impacting demand.
Northam Platinum was another one that released their earnings, and at some point it was down about 6%. It's down about 5.7%. What did you make of the trading update? And I suppose, how has Northam fared in that PGM scenario?
Yes, so as you said, the market has been a bit more negative in reaction to Northam's trading statement. We think that the trading range, which is saying that earnings will be down roughly 90% for the 6 months to the end of December, we think that that is below investor expectations. It's as a result of a couple of things. The biggest driver is definitely lower PGM prices, palladium and rhodium, as we've said before. And this is something that's not affecting just Northam, but of course the sector as a whole. What is on the more encouraging side is that volume growth at Northam is still industry leading at low double digits, about 10 or 11% in terms of year-over-year volume growth. That should help to offset inflationary cost pressures if it's done well. Having said that, the actual earnings number, which at the midpoint is about R1.20, looks quite slim, especially when you compare it to the share price, which is roughly 105, 106 Rand.
When you have these dynamics of softer PGM prices as well as the logistics bottlenecks locally, what does that mean for M&A activity in the mining sector? Is there scope for it for this year?
I think we have seen some M&A activity, not just in the PGM sector, but the broader mining sector. So, for example, last year there was the love triangle between Northam, Amplats and Amplats, which Impala ended up winning. If you look within diversified mining, or let's call it bulks and base metals mining, we saw BHP complete an acquisition of Oz Minerals. South 32 has been active acquiring copper operations. Within PGMs, we've seen Sibanye-Stillwater acquire base metals operations. So there has already been quite a bit of M&A activity. We think that the downturn will allow companies with better balance sheets to perhaps put their front foot on the pedal in terms of M&A activity. But I think generally weaker positioned or weaker balance sheets will obviously prohibit some companies from doing that.
What's your medium to long-term view on the PGM sector?
Yes, it's really fascinating. I think that's the $1 million question everyone's trying to grapple with. The way we would frame it is that we think that this decline in PGM prices over the past, let's call it 18 months or so, we think that that's more of a return to normal rather than a significant downturn. So we think that the prices we saw, the record highs we saw for rhodium and palladium, were obviously at the high end of things and due to quite tight markets. And what we're seeing now is more of a return to normal. In terms of, let's call it long term, I think your guess is as good as anyone's in terms of what happens to electric vehicle penetration and the effect that that'll have on demand.
Yeah.
But over, let's say, the medium term, maybe the next 1 to 3 years, we think that we've made a return to normal in terms of PGM prices.
Seleho, thank you so much for your time. That is Seleho Tsatsi, who's an investment analyst at Anchor Capital.